I'm pleased to say that the boss over at Pimco, Manny Roman, joins us now for the next 30 minutes or so. Manny, it's good to see you, sir.
Good to see you. Thank you for having me.
Put us out of our misery, 25 or 50 tomorrow. What's it going to be?
Well, we're in the camp of 25, but you know, I always say we have a crystal ball, and at the end of the day, we'll see what the market does. You know, it may very well be that it doesn't make that much of a difference, and our view is that there will be 3 cuts of 25. And at the end of the day, what matters is where we are at the end of the year.
Well, let's talk about the destination. This is a 3-part act on Wednesday, as you know. It's a decision, it's a set of forecasts, and a news conference, and a big conversation around this table for the last several months. What's the destination? What are they aiming for? What are they shooting for? Where does this land in the next 18 months?
Well, I think you can say that there's less inflation right now, and that in the absence of new data, the destination will be to have lower rates, and the Fed will be very data dependent. And I think sometimes one underestimates how careful they are about new data and how they want to be able to change their opinion. And so if you kind of use this framework, you sort of say, let's do 25 and then let's see where we are, and then probably do 25 and 25. But I think the total sum of the rate cuts may matter more than how they do it.
Which is the reason why people are looking forward and saying maybe the neutral rate's 3.5%. And oh yeah, look at that. The 2-year yield right now is about 3.5%. Back in June, when you put out the outlook for Pimco, there was a feeling that intermediate bonds really had a fantastic investment proposition just simply because there was yield. Do they still, after the rally we've seen?
We still do think so. And listen, the exciting thing about being at Pimco right now is that fixed income is quite attractive. And you know, we are in a business of feast and famine, right? So when rates are very, very low, it's harder to be that excited about fixed income. And when you can build portfolio and get a yield of 6.5, you become very excited. And you know, we're very focused on treasury. But the reality is there is a lot of value in other part of the segment, asset-backed being one of them. And you know, we're excited about what we see, and at the end of the day, the yield on the portfolio is a good predictor of the return that the investor will experience. And so what I think is exciting about fixed income right now is you can build a portfolio and get a return of 6.5% with a series of different instruments.
It used to be that bonds did better in bad times and worse in good times. Are we heading into a worse time where people go to bonds for safety, or is this on just an absolute basis, yields are higher?
My partner Dan Iverson, and I'm going to quote him because actually he has a very good line. Bonds may be the most attractive asset class, and I think that there's an absolute argument and then there's a relative argument. And I think the relative argument is to say, you need to build a portfolio, you need equity, you need fixed income, you need some real estate, you need some private asset. And at the end of the day, fixed income is much more attractive than equity given the earning yield and given the valuation of the equity market. And I think that's one of the arguments for owning a larger part of fixed income. And I think when I travel the world, I think that people are underinvested in fixed income, and a lot of them are looking at putting more money into fixed income, and whether they do it tomorrow, whether they do it 2 weeks from now or 2 months from now, I don't know. But the reality is people were underinvested various parts of the fixed income market, and they're looking to readjust their allocation.
Have you got confidence we've reestablished the inverse correlation between bonds and stocks?
I don't know what I don't know, and I think correlation fluctuates over time. I think that fixed income have a role in the portfolio construction, and I think they're there for a reason. But of course, credit spread in the high yield market are correlated to equity prices. So once again, I think one needs to be careful about how you frame the question and how you conclude.
Well, I guess I would be more specific by saying, have treasuries re-established an inverse correlation with equities? Because one of the risks that we've seen established over the last few years, particularly given the central focus was inflation, is that when bonds sold off, equities did too. Have we changed that story? Have we left that behind?
Hopefully we have. But I think remember that we also saw with the pandemic really an unprecedented program of money creation, which sort of threw everything and our economic textbook in terms of how we thought about the correlation. And so I'm careful about what I say because the data are just so skewed in terms of what we saw. And I think, you know, you can make the argument, for example, that part of the reason why the US economy has done so much better than any other places is that the package in terms of the pandemic has been so much bigger than in another country. And at the end of the day, all you can do is cross-sectional analysis and try to compare different countries, but there's so many other variables that comes into the picture that you don't want to understate the enormous creation of great company in the US versus Europe, for example. And so I think we try to always be careful about making definitive conclusion when it comes to correlation and when it comes to cross-sectional comparison between different countries.
Another way to frame this question is when you travel the world and you talk to international clients who are underinvested in fixed income in the United States, how many of them turn to you and say, what about the US deficit?
Well, my friend and partner, Richard Clarida, used this very American expression and says the U.S. is, let me try to make sure I get that right.
Carry on.
The cleanest dirty shirt. And, we have debated quite a bit at a forum about deficit and deficit do matter. And they do matter. And at some point in time, there's a tipping point, but we're not there. And the reality is it's a huge competitive advantage to be the reserve currency. People need to own dollars. And the reality is we don't think there's a crisis coming and that the US can have certainly a high level of debt versus historical precedent and be able to function just fine.
When will the US get there? And do you see either party have any impetus to try to rein in spending?
So to quote my partner once again, Libby Cantrell, who comes often here on the show, no, we see no impetus to try to deal with the budget deficit. The only real example we have is the United Kingdom. And I think that the United Kingdom was actually quite interesting because you saw a situation where the bond market reacted so violently to the Liz Truss proposal that all of a sudden they had to change really, really quickly. And I think that this example of what happened in a very developed country and how the Bank of England reacted really quickly with the LDI situation and the pressure in the gilt market and in the pension market will be a textbook example of why markets react quite strongly when something outrageous comes.
Well, we have a Bloomberg survey to that point that says Kamala Harris, a victory for her in the White House would be better for treasuries and worse for stocks, vice versa for the former president. Would you agree with that scenario analysis?
I think there's so many unknowns. It depends on what happened in the House. It depends on what the winner can do in terms of program, how this is all going to pan out. I would be very careful about making any prognosis on this matter. I think when we think about the world, I realize politics is really important.
Yeah.
But at the end of the day, that's not how we invest. We invest because we find value and we find opportunity and we try to buy cheap and we try to manage portfolio and think about risk carefully and ride different cycle and deal with many other factors than politics. And there's a few exceptions. If you talk to my partner Pramal Dawan in emerging market, all of a sudden, in emerging markets, sometimes politics do really matter because they are very big changes and very big different outcomes.
The struggle, Manny, as you know, is that some DMs have traded like EMs over the last few years. And you mentioned the UK, so I won't put words in your mouth. I do want your views.
Well,
it does feel like a self-imposed debt break in the United Kingdom. And I'm wondering whether, from your perspective, for you and the team, that actually makes UK government debt a little bit more attractive here.
We think it's very attractive. We like the UK, we like Australia. We think that the UK fits very well in the portfolio and they will need to cut rates significantly. And so when you think of a global outlook, the UK looks good for a fixed income investor.
Relative to the United States, say, in terms of duration risk?
Relative to other countries in Europe, certainly compared to European bonds. We also like the US, so if I want to kind of sum up things, we like the US, we like the UK, we like Australia.
Manny, I want to come back to the bond market and just talk about a dynamic that started to really take hold over the last month or so. The 2-year, 10-year segment of the yield curve, things just starting to normalise, bit of steepness, almost back to double figures this morning. As we get that curve normalisation, can you walk me through how much things change in fixed income, whether you're starting to see that cash deployed a little bit more?
Well, I think there's that, and of course, people kind of look at the cash they have on the sideline, and there's about $10 trillion of money in cash where they will think to reinvest it, either by extending duration or by going longer or by taking a bit more credit risk. So there is a wall of money out there. And I keep on saying this. And of course, some of it is cash corporate and will remain cash corporate. But I think people have been very much on the sideline rolling short-term treasury bill. And this money will get redeployed. And how fast and how remains to be seen. The other thing which I think you may find interesting is there are a lot of opportunity in relative value in the fixed income market, and in particular, think of Japan. You know, nothing happened in Japan for 15 years, and then all of a sudden, we now have positive rates in Japan. And there's a lot of arbitrage to be done. It's across the curve, it's with swap, it's with different instruments, and all of a sudden, there are sources of alpha, as we tend to call them, where basically they didn't exist 2 years ago, which have come back to the market in spade. How long it lasts, we'll find out, but it should be a very exciting opportunity in terms of the whole market, in terms of delivering better performance.
How difficult is it to pry that cash out of people's cold hands, given the fact that people really do like what they're getting? And, oh, by the way, there are 15 other fund managers out there also trying to get them to pry that cash out of their hands.
Well, I will tell you, competition is good for everybody. And at the end of the day, there's two things. There is, when the Fed cuts rate, eventually the short end of the curve becomes less attractive, and I think you'll see cash moving. And from a competitive standpoint, we want to do the best possible job in terms of being a fiduciary and doing a good job in terms of performance and being there for our clients. And we compete every single day. And hopefully we win more than we lose. But all we can do is try our best, and we're trying very hard.
Where's the edge? Where's the sort of growth concentrated in, or is trying to be concentrated with respect to Pimco in the, say, 5 years ahead?
Well, Asia has been quite exciting lately, and there's a lot of things happening in Asia. And you can sort of think of a business as being linked to GDP in terms of the saving rates, and people, when they save more, invest more. And so Asia has been quite exciting. And the US is an absolutely wonderful place. I mean, it's a big market, and there's a lot to be done. We have a very good Canadian business. We have a very good Latin American business. There's a lot of good things happening. But the one variable we don't control is, of course, the macroeconomic situation. And so if you have a real reversal and you have, for example, a recession, and let me just say it's not our scenario, but if you have a real recession, people become more risk averse and take some money away. And at the end of the day, you know, we're here for the next 20 years, not for the next 20 minutes. And so, you know, we have very liquid portfolio. People can take their money whenever they feel like and reinvest and so on. And we understand that people need money for all sorts of reasons.
There are a number of behemoth asset managers. Pimco oversees $1.8 trillion. How much bigger could you see it getting?
It's all about performance. And I always say the great thing about not being public and not having to give quarterly earnings is you focus on what matters. The circle of truth is if you perform, they will come.
You said this last time we spoke. Don't measure our success by assets. We measure our success by the returns we provide. Does it disappoint you? Is it slightly upsetting that people do measure your success by assets? Because they've been pretty stable now for the last decade. BlackRock over the same period has multiplied. Is that disappointing to you that people judge you by that?
I think we have a very different business model. And, you know, we were talking about Walmart. We don't want to be Walmart. Walmart is a fantastic company, but we have an opportunity set where we very carefully think about capacity and how much money we can put to work and what the right target return are for investors. And I think that, by definition, means that we won't be the largest asset manager, and so be it.
When it comes to asset management, private markets comes up all the time, and everyone's trying to make their own push. Where does Pimco fit into that big push at the moment into private markets?
So we try to focus on what we know how to do. And what we know how to do is fixed income, and so that includes, as a matter of fact, everything which has to do with private market and fixed income, and it also involves real estate. And there's a big real estate cycle that should be exciting. There will be pieces to pick, and there will be cheap investment, both in debt and in equity. And in the private credit market, there's quite a unique opportunity in asset-backed lending. That's where my friend Dan Iverson grew up in, We have been doing this for 20 years. And the one thing which has changed, so to speak, is the banks need to free up capital. And so they need to sell large portfolio of many different assets and do it fairly quickly. That's an opportunity for us. And so if they are good entry point and good asset to pick, we should be able to do quite well.
What types of assets? Are you talking about commercial, or are you going to be owning big residential
mortgage,
swaths?
All bonds
Rental
that
homes?
banks... let me just focus first on fixed income. You know, I think in fixed income there's a lot to buy. And there's a lot to buy because the banks need to delever. And so the banks, you can think about what they have on their balance sheet. They have loans that they've given to company and they want to get rid of it. And so they sell it to us. And that, I think, is fairly straightforward. In real estate, you have a real estate cycle, and there will be different things you can do. There will be, some will need pref equity, some will need debt, some will need to buy equity, and we just need to make sure that it's cheap enough and that we think carefully about what happens and make sure we have an expected return which compensates for the risk. And it needs to be high because there's a lot of risk in commercial real estate, for example. But we had a pretty fast cycle, and hopefully we're going to be on the right side of the trade coming out of it.
We've only got 60 seconds left with you, so the hardest question of the morning. What's more likely, Arsenal winning the title or the Federal Reserve engineering a soft landing?
Arsenal winning the title.
Arsenal winning the title?
Yes.
Should I read into anything about your real views on the economy then, based on that, or you just think Arsenal's that good?
No, you should. You should think about Arsenal. No, I think. Look. I think people are very. Sometimes criticize the Fed. I think they do a really good job with a very difficult hand to play, and you know, they don't know what they don't know at the end of the day. And I think it has been a tremendously complicated market to navigate for everybody over the past 4 years. None of us ever thought we would see a pandemic, and you know, from a investment standpoint and from a regulatory standpoint and from the Fed standpoint, I think we had to learn a new playbook.